Welcome back to Sethtra Academy, where we study not just money, but the mechanics of staying rich. Most investors believe growing wealth means working harder, chasing the next big thing, or timing the market perfectly. But what if I told you that's not the whole story? The truth is, the rich don't just work harder. They rebalance smarter. Think about it. Every storm in the market, every crisis on the news, it doesn't seem to destroy the truly wealthy. Why? Because their financial systems know how to self-correct. That's what we're talking about today, the quiet, powerful secret of rebalancing. It's the invisible discipline that keeps your wealth alive and growing, even when everything else feels like it's falling apart. Wealth doesn't just disappear. It moves from those who forget to rebalance to those who don't. So what exactly is rebalancing? Let's be clear, it's not frantic trading. It's not guessing market tops and bottoms. It's simple mathematical adjustment. Rebalancing means reviewing your portfolio every few months or once a year and bringing it back to the original structure you designed. Here's why that's crucial. Over time, as the markets move, one part of your portfolio will inevitably grow faster than others. Your winning investments start to take up a larger and larger slice of the pie. If you don't reset that balance, your portfolio silently shifts from safety to danger, all without your permission. It's like a ship slowly tilting to one side. At first, you don't notice, but eventually it becomes unstable. Professionals rebalance because they don't react emotionally. They realign mathematically. It's about maintaining control. Imagine a bamboo bridge in a small village by the Mekong. This bridge is built every dry season. As the river's current changes, the villagers don't tear down the bridge and start from scratch every time there's a shift. No, they adjust it. They move a few poles, tighten some ropes, and reinforce the planks that need support. They rebalance the bridge to match the new reality of the river. Because what was balanced yesterday might not be safe today. This is exactly what smart investors do. They don't panic and destroy their portfolio when the market shifts. They simply rebalance the bridge, ensuring it remains strong and stable, ready to carry them to their financial destination. Now, let's talk about the silent danger of not rebalancing. Imagine you start with a simple portfolio following a 60-30-10 rule. 60% in stable, long-term stocks, 30% in bonds, and 10% in a high-risk, high-reward asset like crypto. The market has a great year and that 10% in crypto doubles in value. This is how people lose fortunes. It's not always because of bad investment picks, but because they let their winners run so far that their portfolio's risk profile gets completely out of whack. There's a saying among professionals, if you don't control your portfolio's weight, it will control your emotions. And as we all know, emotions are the most expensive mistakes in finance. So how do the rich actually do it? They follow a schedule, not a feeling. They don't wake up one morning and think, maybe I should sell something today. They have a system. They review their portfolios quarterly or annually, like clockwork. If their riskier assets have grown too much, they'll sell a portion of the profits and move that money back into their safe or moderate growth zones. If the safe zone, like bonds, becomes overweight because stocks have fallen, they'll move some capital from the safe zone back into the opportunity assets, buying them at a lower price. They don't chase performance. They preserve proportion. That's the secret to how wealth endures for decades. It's about balance, not brilliance. When it comes to the system itself, there are two main ways to rebalance. The first is calendar rebalancing. This is the simplest. You just pick a date and stick to it. For example, you decide to rebalance your portfolio every 6 months or once a year on your birthday, regardless of what the market is doing. This method is excellent for building habit and discipline. The second method is threshold rebalancing. This is a bit more flexible. You set a rule that you'll only rebalance when any part of your portfolio drifts too far from your target, say, by 5% or 10%. This means you might rebalance more often in volatile markets and less often in calm ones. Honestly, both methods work. What matters isn't which one you choose. It's that you actually do it. Inaction is the enemy. It's what slowly allows the structure of your financial future to erode. Let me tell you a short story about a farmer. This farmer planted 3 crops, rice, corn, and sugarcane. The first year, the rice grew wildly, producing an incredible harvest. He was so happy that he decided to focus only on rice, neglecting the other 2 fields. For a couple of years, it worked. But in the third year, a pest that specifically attacks rice plants swept through his fields, and he was left with nothing. His neighbor, however, took a different approach. Every season she adjusted. She saw which crop needed more attention, planted more of what was struggling, and harvested the excess from what was thriving. After 10 years, she had more food, more stability, and no fear of a single pest or a bad season. That's what rebalancing is. It's farming your money. It's not glamorous. It's not exciting, but it is how wealth survives and thrives for decades. And here's where the magic really happens. Rebalancing amplifies the power of compound interest. Think about it. When you consistently take profits from the overperforming side of your portfolio and reinvest them into the underperforming side, what are you really doing? You are systematically selling high and buying low. You're buying value at a discount automatically, without having to guess. Each rebalancing cycle enhances your long-term growth without you having to add a single new dollar of income. This is how billionaires can seem to grow richer in their sleep. It's because their portfolios are designed to quietly adjust and optimize themselves while everyone else is panicking over the news. Ultimately, rebalancing is self-discipline in disguise. It teaches patience. It's a ritual of imposing control over chaos. It reminds you that long-term investment success isn't about being a fortune teller. It's about consistent correction. Every time you rebalance, you are making a powerful statement. You're saying, I am the master of my emotions. My system serves my future, not my fears. This is how the rich stay rich, not through constant hustle, but through constant calibration. So how can you start? It's simpler than you think. First, define your ideal portfolio ratios. A 60-30-10 split is just an example. Find what works for your age and risk tolerance. Second, set a rebalancing schedule. Will it be every 6 months, or will you use a 5% threshold? Decide now. Third, keep a record. Track your portfolio like a diary to see how it changes. And fourth, automate where you can. Many modern brokerage platforms and robo-advisors can do this for you, protecting you from your own emotional impulses. Start simple, but the most important thing is to start. Rebalancing is the quiet conversation between your past decisions and your future peace of mind. If this lesson helped you see wealth as a system to be managed, not a prize to be chased, then I invite you to subscribe to Sethtra Academy. Here, we build the science behind financial calm. Thanks for watching. This is Sethtra Academy, where balance is wealth and wisdom compounds forever.